Money advisors. He joins us live out of New York. Jay, good to see you. You're a gold bug. 1459 is what we hit. That's the fresh high. How much higher can we go?
I mean, it's if you can tell me what the policy of the Federal Reserve and the other central banks around the world is going to be, then I could answer that question. I think that all the signals now are that we're going to have an easy monetary policy from virtually every corner of the earth, and you know, as long as we have quantitative
Jay,
easing,
hold on here.
Then I
Jay,
think
hold on here.
Yeah.
Jay, hold on here. What about Europe? You know, first rate hike 1.25 now. We've got markets pricing in 2.5 by the end of 2012. It sounds like they're on the way up.
Yeah, I mean, it's all relative. So Europe, the Europeans take a more conservative stance. I think a more realistic stance. You know, clearly they're more concerned about inflation. That's been sort of a traditional thing. But I see even the Eurozone really being very lax in their monetary creation. I don't think that anybody is going to go back and get real with respect to monetary policy as Paul Volcker did, let's say, in 1980. And clearly I think there's a lot of deception going on in the United States by the policymakers. I think if you look at the real rate of inflation, it's much higher than what they're claiming it is, and that being the case, real interest rates are very, very low, are extremely low. And so people who save and save their money and live frugally are being punished. So it's all about, it's the Keynesian economic model to try to stimulate consumption without saving, and it's a road to disaster as far as I'm concerned. I don't know how high metal prices can go, but I think there's an awful lot of speculation in the commodity markets now that the commodity prices to a great extent are not being driven by the real economy, but rather by a lack of confidence, growing lack of confidence in monetary policy and in paper money, quite frankly.
Is this also a dollar story going on with gold prices, Jay?
I'm sorry?
Is this also a dollar story that we're seeing when it comes to gold prices?
To gold stocks?
Yeah, the fact that we are seeing this inverse relationship between gold and dollar, is it just pure trading based on the back of the currency?
Well, I think to a great extent it is, yes. I think that, you know, with quantitative easing, and we've had decades of permissive monetary policies that have led to one bubble after the next, and really we saw the real price of gold rise very dramatically after the Lehman Brothers decline in 2008, 2009. There was a major shift in the value of gold and silver, the values relative to other commodities. This tells me that people are looking to those monetary metals as a store of value. And to me, it's all about a loss of confidence in the currency. And of course, there's going to be a con job to try to keep people interested in buying treasuries and buying financial assets, because the people who run the system are benefiting from paper money. I mean, we just heard about, you know, these massive salaries that these executives are making. It's just a reallocation of wealth from the people who create it, the miners, the manufacturers, the farmers, the inventors, to the people that control the system, which is really the banking system and the politicians that are in bed with the bankers.
Jay, let me put this to you. We've got a great viewer email from Mihir Shah in India. With crude oil making multi-year highs, inflation skyrocketing, Portugal seeking a bailout, do you see silver at $50 an ounce, gold at $1,600 by the end of this quarter? Is that too aggressive in terms of price targets?
Well, I mean, I think that could very well be the case by the end of the quarter. I hate to put timing, I hate to try to time these moves, because it has so much to do with psychology. You know, how long can people be conned into believing that paper money is worth something? And I don't know the answer to that. But the direction is definitely higher for gold and for silver. And I would argue also, unless we have another credit market decline, a credit market implosion like we had in 2008 and 2009, which I think is a very realistic possibility. Barring that, I think you're going to see commodity prices continue to rise. And by the way, what that does is really hurts the middle class. It hurts the people who have to, you know, who have to spend a big percentage of their income to put food on the table and to drive to work. It's really hurting the middle class in America in a major way.
Okay, let me just make a note for our viewers, the way that you're playing some of these trades, Allied Nevada, Dynacor Gold Mines and Crocodile Gold. Thank you for joining us. Jay Taylor, President of Taylor Hard Money Advisors.